In this session, we will be focusing on the scenario analysis for each of the parameters of the balance sheet, and it's imperative to have an understanding of what are the possible scenarios, the best one, the mediocre one, and a potential disastrous one. As you can see, we have three states: the ideal state, the mediocre state, and the disaster state. In the balance sheet parameter, we are looking at capital, equity, promoters. The desired state is 35%, the mediocre state is 25%, and anything less than 20% is a potential disaster. Similarly, for bank rate, it is 15%. It could be an ideal percentage for term deposits. 8 to 12% is a mediocre one, and anything less than equal to 6% is a disaster. So similarly, we have put in the values for each of the key parameters. Over here, of relative greater importance is the capital adequacy factor for leveraging. Uh, Here, the desired state is less than 5%, is around 5%. If there's a decline by 5%, it would imply that uh, the adequacy of the cost of capital is reasonably good. But in case of 5 to minus 3% is a mediocre one, and greater than 5% is a disaster. If the cost of capital is then we move on into the effective cost of working capital. Could be the ideal state at 10%, 15 to 25%, and more than, and the disaster is more than 25%. These desired states, for comparison, have been drawn in from based on empirical evidence of several organizations and the authors' initiatives in bringing in turnaround of major companies across domains. Now, if the standalone free cash flow, I would say 15% is an ideal state. If 15% of these overall sales is generated in the form of free cash, then it's an excellent state, an ideal state, a desired one. Anything between 8 to 12% is an average state, and finally, less than 6% is a potential disaster. In order for the financial analyst needs to have a guideline for each of the parameter in the balance sheet in order to understand the implications in a much better way and to evaluate to repair the balance sheet in a much better way. So when you're looking at critical factors in a given balance sheet for a given script or a given firm, we are supposed to be looking into these guidelines and evaluating the performances, and would be in a position to take the corrective measures or the bring in on-course correction measures. We are looking at the FCE parameter, the price equity ratio, which is the matrix will give us the list of parameters in the FCFE and their relative parametric influences, parametric strengths, and then the influence variables. And finally, we have a scenario analysis for the FCFF evaluation. In this particular case, the first and foremost important is the PE, the price earnings ratio, which is influenced to a large extent by productivity, yield, and quality leadership as the principal variables of the free cash flow model in the firm, with variable strengths which are substantial. And in the scenario analysis, we look at overall equipment efficiency, which is a function of productivity, yield, and quality put together. And the ideal state could be somewhere around 90%. Mediocre is 65 to 80%. And disaster is less than equal to 60%. In the context of debt to equity, we have a parametric strength of 0.85, the product conversion cost, the sales contribution, and the fund flow differential of 0.88, 0.97, and 0.95. The conversion cost, the measure is a percentage of value goods produced in a timeline. We peg it at the valuation on the production, could be ideal state could be as low as 35% cost of conversion, and the mediocre state is 40 to 55%, and finally the disaster state it could be anything more than or equal to 60%. In the contribution, when we look at contribution, it is the ideal state is 65%, the mediocre is 45 to 55, and the disaster state is less than 40%. Fund flow differential, we look at creditors debtors differential, and this is what we have. So in a nutshell, debt equity is influenced by conversion cost, contribution, and fund flow differential. In case of retained earnings, as expressed as a percentage of sales turnover, which is a critical component in the equity valuation for the free cash flows, we look at EBITDA, top line growth percentage, and the operating margin, and all as a percentage of capital employed with certain standards for the ideal state, the mediocre state, and the disaster state. Then we have the return on capital employed or engaged, where again the EBITDA, top line growth, operating margin growth will functionally give us an idea of how things are going to be influenced by the firm's performances. These are the typical performances of the firm that are going to influence the equity parameter. Finally, we are looking at capital assets growth or in an organic way, where capex accruals, which are financed, where the capex or the capital expenditure uh, as a function of accruals, finance where accruals is of importance. Anything in here it is pertinent to understand or note that anything less than 50% of the financing of the capital expenditure is disasters, is potential disasters, because it is likely to influence the solvency factors in the medium term as well as in the long term. In case of asset efficiency, this is another component or another variable in the firm's performance that is going to influence the equity, and the product innovation as a percentage of sales should be somewhere around 20, 12, and less than 20. Finally, summarizing the entire session, we would be in a position now to look at the various aspects of the integrated approaches to the free cash flow in equity, in evaluation of equity as well as for the evaluation of the firm, and link them to the macro fundamentals of lending rate, the deposit rate, and the purchasing power parity, which eventually are linked with the strength of the currency, the current account uh, dynamics, and of course, finally the growth in GDP, in real GDP and real income. I hope we have had an enjoyable session so far, a series of sessions so far in explaining the FCFE and FCFF, and I sincerely do hope that the students have had a fair amount of compelling grasp on the key concepts that go into the evaluation models for the equity and for the firm. As usual, I would be concluding by reiterating the need to be on an interactive mode through emails and exchange of emails on the topic, on the gray areas of topic, or probably possibly areas which are a little where the realm of understanding is much lower. I would be more than glad to respond to each of your mails collectively and individually to elicit the finer points of the concepts discussed so far in all these sessions, and would be on a learning mode as well while interacting with each one of you. Thank you and have a blessed day ahead. God bless all of us. Thanks.